crypto actually a high potential industry, or are we all just being misled? The crypto market is making major progress in the real world. Corporate treasuries are buying billions in digital assets and governments are creating strategic reserves. The crypto revolution that Satoshi Nakamoto envisioned is finally happening. Or is it? Because there's something happening behind all of these headlines that might actually be the opposite of what Bitcoin was supposed to achieve. Think about it. Satoshi created Bitcoin to be a peer-to-peer electronic cash system. No banks, no governments, no centralized control. The whole point was to give power back to the individuals. But look around today. The biggest Bitcoin holders aren't individual users. They're the exact institutions Bitcoin was designed to bypass. If you look at the numbers, this shift is happening at an insane pace. Strategy just dropped another $350 million on Bitcoin, bringing their total to over 632,000 BTC. This is worth over $70 billion today. Trump Media just announced a $6.4 billion Crow treasury deal, and we saw the impact this had on the Crow token price. As of now, there are now over 90 public companies holding crypto on their balance sheets. And I'm talking about major names: Harvard, GameStop, SharpLink. The list is pretty heavy. The SEC is also redefining digital assets with their Project Crypto initiative. Most cryptocurrencies are no longer considered securities. Banks can now hold crypto. The Genius Act officially recognizes stablecoins as a legitimate asset. Spot Bitcoin and Ethereum ETFs are pulling in record inflows. BlackRock's IBIT ETF alone controls over $80 billion in Bitcoin. That's even more than Strategy's holdings. Let's not forget, Solana, XRP, Dogecoin, and Litecoin ETFs are still pending approval. There's now more than a 90% chance of approval according to Bloomberg, and deadlines for a decision are just months away. We're also seeing traditional financial instruments start to merge with Web3 technology. The dream that crypto believers have had for over a decade is actually coming true. This is exactly what we wanted, right? But here's where things get scary. MicroStrategy and BlackRock together control over 1.2 million Bitcoin. That's more than 6% of the total supply that will ever exist. When centralized institutions hoard a limited resource, they don't just become big players, they become the market. MicroStrategy used debt to buy their Bitcoin, so they have a leveraged position. If Bitcoin crashes hard enough, they could be forced to sell to meet debt payments. BlackRock's ETF doesn't even own their Bitcoin. They're managing it for investors. Mass ETF redemptions would mean BlackRock has to dump Bitcoin to pay out investors. What happens when one of these giants needs to sell hundreds or thousands of Bitcoin? The same thing that happens when a whale dumps. Retail investors get crushed. And let's be honest, these institutions aren't here for Satoshi's vision. They're here for profits just like everyone else. So where does that leave us, the retail investors? Are we just along for the ride while institutions control the market? The institutional adoption wave is definitely bringing legitimacy and massive capital inflows. That's bullish for prices in the medium term. But it's also creating new vulnerabilities that didn't exist when crypto was mostly retail driven. So here's the big question that nobody's asking. Is crypto's mainstream adoption actually a victory, or have we just recreated the same centralized system with different players? And most importantly for crypto holders like you and I, is this bull run actually going to play out the way we think it will? Well, let's dive deeper into this to understand where we could be headed and what that could mean for our portfolio. Now, if you're serious about navigating this market and taking advantage of opportunities as they come up, you need to have a reliable trading platform ready to go. WEEX has been one of my go-to exchanges. The platform is fast, fees are extremely low, and I can get positioned quickly when the charts are showing me clear signals. If you use the link in the description, you'll get 30% off those already low trading fees, plus a chance to unlock up to 30,000 USDT in bonuses. It's free to sign up, so it doesn't hurt to test it out. And when it comes to staying on top of market shifts and altcoin rotations in real time, the FireHustle Discord has been a game changer. We've got a community that's constantly analyzing market patterns, sharing insights on altcoins, and helping each other spot opportunities before they become obvious to everyone else. Link is in the description if you want to join the discussion. As always, none of what I share is financial advice. Please make sure to do your own research before making any financial decisions. Now, hit those like and subscribe buttons, turn on post notifications, and let's get started. So there's a general understanding that the crypto market reacts to global liquidity. But with more institutional adoption now, does this change anything? Looking at this chart, Bitcoin has historically followed M2 money supply growth with a short delay. When central banks print money, M2 goes through accelerated growth, and that's what these large green areas are showing. And Bitcoin eventually explodes higher. A great example of this was shortly after the COVID lockdown began. Stimulus injections created this large area on the graph in 2020, and this fueled Bitcoin's push last cycle. Then, when money printing slows down, Bitcoin crashes. The M2 metric has been one of the most reliable macro indicators for crypto. But here's what's different now. Global M2 is expanding again, and the Fed is signaling rate cuts with a high probability in September. This should be rocket fuel for Bitcoin. But institutional flows create a new dynamic. For example, Strategy isn't buying because M2 is expanding. They're buying because they have debt to deploy and quarterly schedules to maintain. Michael Saylor believes Bitcoin is an appreciating asset, and this is a strategy to hedge against inflation. And of course, at the end of the day, it's about growing value in the company. Now, the second chart shows Bitcoin and M2 with a 10-week lead adjustment. You can see periods where they move together, which supports the idea of Bitcoin reacting to money supply changes with a delay. There are also periods where they completely disconnect. So it's not really a perfect correlation. It's possible that institutional flows have made Bitcoin less sensitive to these macro cycles. But if Bitcoin continues to climb over the next month or so to follow the global liquidity pattern, then it's possible that this correlation still stands overall. And M2 continuing its climb could signal a new peak for Bitcoin in the short term. Now, if institutions are really treating Bitcoin as a strategic asset rather than speculative crypto, we should see a correlation with the stock market. And that brings us to the S&P 500. Looking at the long-term chart, Bitcoin in blue and the S&P 500 in red tell two different stories through most of crypto's history. From 2013 to around 2020, Bitcoin moved independently from the stock market leader. While the S&P 500 had its steady climb with occasional corrections, Bitcoin went through massive run and crash cycles that behave separately from traditional market conditions. But look at what happens starting in 2020. The lines start moving much more in sync. When COVID hit and both markets crashed in March 2020, they both recovered together. During 2021, they climbed together. And when the Fed started raising rates in 2022, both assets crashed together. From late 2022 to 2025, Bitcoin and the S&P 500 have been moving almost side by side. When stocks rally, Bitcoin rallies. When stocks pull back, Bitcoin pulls back. This is exactly what we'd expect if institutions are turning to Bitcoin as an investment option. When funds and corporate treasuries are picking up Bitcoin, they're treating it as part of their equity allocation, not an alternative asset. But here's the problem with this correlation. If Bitcoin is becoming more of a traditional asset, then it loses its position as a hedge against traditional finance. And this means Bitcoin will likely get crushed in any major stock market correction, taking retail crypto investors down with it. And of course, this would have a domino effect on the altcoin market. But here's where things get really interesting. If Bitcoin is supposed to be digital gold, then how is it actually performing against the real thing? Well, looking at the long-term chart, Bitcoin in blue absolutely crushed gold in orange over the past decade. While gold had its ups and downs, Bitcoin had a monstrous climb overall. Bitcoin advocates had every right to claim victory for digital gold over physical gold. But look at what's happened since institutional adoption really took off. The more recent chart tells a different story. Since early 2024, gold has been quietly outperforming Bitcoin. While Bitcoin has been volatile and struggling with consistent momentum, gold has been on a steady climb to new all-time highs. In 2025 specifically, gold is up about 29% year to date, while Bitcoin is only up around 25%. Think about what this means. Gold, the 5,000-year-old store of value that moves slowly, is beating the new digital asset that's supposed to transform finance. Why is this happening? Well, it comes back to our central theme. When institutions treat Bitcoin like a risk asset instead of a safe haven, it stops behaving like gold. Real gold benefits from times of uncertainty and market instability. Bitcoin gets sold alongside stocks whenever markets get nervous. It's a fact that central banks are buying physical gold at record levels. But when they want digital assets, they're buying Bitcoin through regulated ETFs, which changes how Bitcoin trades. The more Bitcoin gets institutionalized, the less it behaves like the digital gold it was supposed to be. And if Bitcoin continues to get outperformed by gold, then can it really be called a true store of value? Well, there's still hope. Let's look at the US dollar index. This measures the strength of the US dollar against other major currencies. And according to this graph, Bitcoin has always moved in the opposite direction. When the dollar was weak from 2011 to 2017, Bitcoin exploded higher. When the dollar strengthened in 2015, 2018, and 2022, Bitcoin crashed. This makes sense. When the dollar loses value, people look for alternatives and Bitcoin benefits. Now, the shorter term chart shows that even with all the institutional adoption and correlation with stocks, Bitcoin is still maintaining this inverse relationship with the dollar. While DXY has been falling over the past year, Bitcoin has been climbing. And this suggests that despite all the changes we've discussed, Bitcoin hasn't completely lost its strength as an asset. While institutions might be treating it like a risk asset in the short term, over longer periods, it's still functioning as a hedge against dollar weakness. And this could be the key to understanding Bitcoin's future. Maybe Bitcoin is evolving into a hybrid asset, more correlated with traditional markets day to day, but still providing protection against currency weakness over long-term horizons. If that's the case, then institutional adoption isn't destroying Bitcoin's mission. It's just changing how we need to think about it. The dollar is facing long-term challenges from massive debt levels, geopolitical tensions, and countries looking to reduce their dollar dependence. If Bitcoin can still serve as a hedge against these macro trends, even while being volatile in the short term, then maybe the digital gold narrative isn't dead. It's just evolving. So what does this all tell us? Well, institutional adoption of crypto may be on the rise, and that might be impacting the behavior of Bitcoin and the rest of the market. But that doesn't mean that the mission for crypto is a failure. Yes, large institutions are holding massive amounts of Bitcoin. They have the power to really hurt the market if they wanted to. And yes, the more traditional finance overlaps with crypto, the more Bitcoin will act like a stock rather than a store of value on its own. But the general agreement is that Bitcoin is a hedge against inflation and against world currencies. This is important if we're considering how fragile the US dollar really is. With this in mind, I do still believe that the bull cycle will play out the way we expect it to. A bigger run up and then a crash. What might be different this time is the timing and the extent. We could see this run up last longer than we initially thought. So instead of a peak at the end of this year, the bull run might continue into 2026 and maybe even beyond. And when a crash does happen, it may not be as severe as past cycles, just because of how much involvement we're seeing from large institutions and even governments. There's way more support now for crypto assets and products. We keep saying that this cycle is different, and these are the reasons why. Of course, none of what I share is financial advice. Always do your own research before making any financial decisions, especially in the crypto space, which has its own risks. If you found this video valuable, then check out the FireHustle Discord group. We have a community that constantly shares market insights and opportunities in real time. Link is in the description if you're interested. And don't forget to hit the like and subscribe buttons and turn on post notifications so you don't miss my next post. Hope you guys enjoyed the video, and I'll see you in the next one.